Good evening, dear listeners. You are most welcome to today's mock debrief. We are going to look at CPA Paper 11, Taxation, and specifically, we shall be focusing on the mock that was sat on 18th of April 2026. This mock or this debrief is to prepare you for May 2026 examinations, which will be sat on 20th of May 2026. The exam is on level 2 and it takes 3 hours to be done. And it has 2 sections. That's section A and section B. Section A is compulsory and section B is optional. Section A takes 40 marks and section B takes 60 marks. Making a total of 100 marks. The structure of this exam, it is 60% computational and 40% theoretical. So as you are reading, as you are preparing for this examination diet, always ensure you put efforts on those areas. Ensure that you're not only concentrating on computational areas, you need to mix in some theoretical areas for you to be able to pass the exam. So today, we are going to focus more on number 1, section A, and a bit of section B. And in here, we are going to look at the questions that was done by students at MAT Abacus Business School on 18th of April 2026. We're going to dive into the questions, but before we go there, I will first take you through what is expected of you as a student of this paper. 1, you need to note that section A, like I told you, it is a compulsory section, and in the previous sittings, the examiners have focused on business income, and this is the core area on this number. And it normally takes 40 marks. Once it is examined, the examiner is expecting you to interpret an income statement. So they normally give you a statement of comprehensive income. Statement of profit or loss and other comprehensive income. They give you this information and they expect you now to compute the tax payable. They expect you to compute the tax payable. So you as a student, you need to understand, how do I pick information from the statement of profit or loss and I compute the tax to pay? Because as an accountant, because like this number is picked from the 2 concepts. It has 2 perspectives. We have this perspective of the accountant, of the perspective of the taxman. So the accountant prepares financial statements in accordance with IFRS, the National Financial Reporting Standards. The taxman expects tax to be prepared in accordance with the tax laws of Uganda. So when the accountant is preparing the information, he has used International Financial Reporting Standards. And the taxman expects you to use tax laws. So there is always a conflict between these two, because the recognition of incomes, expenses, and other elements of financial statement is different from how the taxman expects them to be. So because of this, the question or the examiner will give you information as prepared by the accountant. He will give information as prepared by the accountant, and he will expect you to interpret this information using the tax laws to come up with the tax payable. And that's what will be the focus of this debrief for this particular number. So let's go into the question and look at it. Question 1. Once you are given this question, first you need to read the required. After reading the required, then you check the question so that as you are answering, you have at the end in mind. So question 1 required, it says determine MBL's chargeable income and tax payable for the year ended 31st December 2025. In accordance with the Tax Procedure Code Act, advise management of MBL on the one circumstances under which the commissioner may reject an application for a private ruling for marks, the meaning of a tax agent, and the circumstances under which the committee may cancel the registration of a tax agent. So let's now go into the question and see what it requires. It says, Madueke Bottlers Limited MBL is a company incorporated in Uganda that specializes in the manufacture of sportswear, including football jerseys and boots. The company operates its main factory along Masaka-Mbarara Highway in Mpigi District, with an additional branch located in Mtoma District in Western Uganda. Below is a statement of profit or loss and other comprehensive income for the year ended December 2025. So as you are reading this question, you need to check 2 things. One is the entity that the question is picked. So you see this one is picked from a manufacturing entity, meaning that the assets and the assets will be in a manufacturing entity. The assets will be in a manufacturing entity. So let's continue. So we're going to have our heading. We're going to have our heading for the question. So the heading is MBL chargeable income, MBL chargeable income, and tax payable for the year ended 31st December 2025. So when handling this question, we start with PBIT, profit before income tax. Then we add back non-allowable deductions. Non-allowable deductions. So PBIT is always given in the question. When you go to the profit and loss, there is PBIT. PBIT is always given, it is here, which is 827,202. 827,202. 827,202. Then add back the non-allowable deductions. And down, we will have less allowable deductions. Less allowable deductions. Less allowable deductions. Now, as you are looking at this question, you need to start with additional information. So the examiner gives you the profit and loss, and the profit and loss has notes, not 1, not 2, 3, up to 5, sorry. So you start with note 1. Note 1 is about other incomes. So other incomes, we have unrealized foreign exchange gain. So unrealized foreign exchange gain is income that is not yet earned because it is unrealized. So it is, you cannot tax it. So it is not taxable. So you put it under allowable deductions. Unrealized foreign exchange gain. Exchange gain of 72 millions. Then bad debts recovered. Bad debts recovered is considered as income, and given that the accountant has considered it in his other incomes, we do nothing to it. Next is rental income. Rental income is taxed separately, so we remove it from here. It's a rental income. This one is taxed separately. Taxed separately. So rental income of 90 million. Interest from treasury bills, it is a final tax. So that you also less it. Interest from treasury bills of 52,000. Of 52,000. Then you have general and administrative expenses include 182 million spent on acquiring a software with expected useful life of 8 years. So first, we need to first allow the software, the amortization of the software is allowed. Software, so we amortize it, we get 182 million divided by 8 years. So then the whole cost of 182 is disallowed. So we get 182,000 divided by 8 years. So we shall get 22,750. That becomes an allowable deduction. Then we go up here and we record the software. Software cost becomes a non-allowable deduction of 182,000. Other operating, note 3, other operating expenses include 82 million used for purchase of sewing equipments used in manufacture of jerseys. So these sewing equipments, each, they are capex, they are capital expenditures. So we have sewing equipments. So equipments, there are 3, so it is 3 times 82 million. You get 3 times 82 million, 3 times 82 million, you get 246. 246 million is disallowed. So this will be taken to wear and tear. Be taken to wear and tear schedule, given that it is a capital equipment. Fines and penalties for bad driving. So fines and penalties are added back. Fines and penalties, you add them back to 97,000. 207 million for provision for bad debts. That is also a disallowed expenditure. Provision for bad debts, you also disallow it, 207,000. Factory wear, 57 million was for factory wear. Factory wear or uniform that is given to staff is an allowable deduction. Annual staff parties, staff party is disallowed. What you need to note is that section 22, subsection 1 gives a general principle on expenses that are allowable and expenses that are disallowed. And it specifies that expenses incurred in production of income, included in gross income, are allowed as deductions. And expenses not incurred in production of income, included in gross income for the year of income, are disallowed. So this staff party is not a business expense. Depreciation for right of use relates to acquisition of right of use for Premier League logo plan for 7 years at a cost of 388. So we shall remove this. We shall say a Premier League logo. So first of all, we shall disallow the whole depreciation amount, and then we bring this one as amortized. We bring the amortized cost as an allowable deduction. Premier League logo. So we shall have 388 divided by 7 years. So we get 388 divided by 7 years. 388 divided by 7 years. This will give you 55428 as an allowable deduction. So then the whole depreciation amount will be disallowed. We move the selling, distribution, and marketing expenses include sponsorship of local church of shillings 98 million. Sponsorship, these are the donations. Donations are disallowed expenditures. Donations we disallow 98,000. Tax written down values. So they have given you tax written down values. So after you've finished looking at what is given in the additional notes as allowable and not allowable, then you go back to the face of the profit and loss and pick items which are on the face disallowed or allowed. You bring them to this computation. So looking at this profit and loss that is given to us, I can see depreciation of property, plant, and equipment. So this depreciation of PPE that we add it back 504,000. We have depreciation for right of use. Depreciation for right of use asset, which is 163,449. I think those are the only items included there. Then after that, the question goes ahead to give us the tax written down values in each class. So then we move to that. So we shall go down and have workings. So we shall come here and have workings. So working 1 will be for wear and tear schedule. Wear and tear schedule. The wear and tear schedule, which is sometimes called depreciation allowance, has 3 classes. So we shall have details here. Shall have class 1, class 2, class 3. So you start with the tax written down value, balance brought down. So the balance brought down is normally given in the question. In class 1 we have 601,470. This is 248,900, and this is 191,780. Then after that we add additions. we put additions. The addition is the assets that have been acquired. Now, as a general rule, class 1 handles assets, which we call data handling equipments, computers and data handling equipments. Class 2 is equipments used in manufacturing and farming. And class 3 is any other equipment not mentioned in class 1 and class 2. So in the additions, they are telling that addition is made during the year to the Mtoma district branch. Now, the other thing you need to note is that you do not have to consider the location of the assets. Whether they are in branch A or branch B or up country in Kampala, that does not matter. So here we have a factory equipment. A factory equipment. So the factory equipment, given that it is a factory, it will be in class 2. It means that it is used in manufacturing. 497,200. Then we have distribution trucks. Distribution trucks. So distribution trucks are in class 3, which is 1,406,800. From there, you have Jazay's sewing machine. So the Jazay sewing machine is in class 3, 381,600. It is in class 2. Then we have office, furniture, and fittings. That is in class 3, which is 52,100. Then we have CCTV cameras. CCTV cameras are in class 3, is 12,800. Now, what you need to note, examiners, sometimes they can give you assets under additions, but these assets are what you call minor capex. So when you look at this note 7, they gave you 20 mobile phones. So 20 mobile phones, when you get 18,400 and divide by 20 mobile phones, you find that each mobile phone is costing, when you get 18,400, you divide by 20, you will get 920,000 for each mobile phone. Now, what this means is that any asset whose value is less than 1 million is a minor capex and cannot be included in the wear and tear schedule. Cannot be included in the wear and tear schedule. It will be considered as an allowable deduction. So mean that we shall go to allowable deductions and allow this as a minor capex. Minor capex mobile phones of 18,400. And now it will not appear in the wear and tear schedule. So when you are given this, you need to first check what is the cost of each item. They also go ahead to tell you that during the year, but before you continue, there is this asset that we had put up here that would say that it is a capital expenditure of 82 times 3. Remember, when we were up here, we added the asset. It is where the software cost of 182. The sewing, this one here, 246 as sewing equipment. So we come down, we bring it here as sewing equipment. It is, since it is sewing, it is 246. It is in class 3, class 2 because it's used in manufacturing. After that, then you continue and include disposals. they have said that during the year, computers and furniture and office furniture were disposed of at 100 million and 140 million respectively. It means that we need to include disposals here. So under the disposals, we have computers. Like I told you, computers are in class 1, which is 100 million. So this will reduce the amount of money we have there. Then we also have, so there is nothing in class 2 for computers and class 3. Then we also have furniture. Furniture is in class 3. So they disposed of 140,000. Okay, so that's all for the assets. Then you need now to balance off. To balance off is to get the subtotals for each. Before you put the depreciation allowances. So what you also need to note is that class 1 is at 40%. Class 2 is 30%. And class 3 is 20%. So then you now add. So I will add, get to my calculator. I get 601,470. I subtract 100,000. So what will be the answer? The answer will be 501,470. This is for class 1. Then I do for class 2. Class 2 is 248,900 plus 497,200 plus 381,600 plus 246,000. So the answer I have is 1,373,700. Next, I have 191,780 plus 1,406,800 plus 52,100 plus 12,800 minus 140,000. That gives me 1523,480. So these are my subtotals after getting additions plus the disposals. Then I will multiply by the depreciation allowance. This is 40% times 30% times 20%. So this is what we call the wear and tear rates. Then from there, I will get wear and tear allowance. So the wear and tear allowance will be after getting those figures, and I multiply by the rates. So I can start with the last one, 1.523480 times 20%. So that will give me 304,696. Then 1,373,700 times 0.3 to give me 412,100. 501,470 times 0.4%, 40% to give me 200,588. Remember, these are allowable deductions, so can put them in brackets. And when I get this, the subtotals, and I remove the wear and tear schedule, I get what we call the tax or return down value, balance carried down. Now this is the balance that I will take into the next year. Now the next year, which is starting on 1st January 2026, will be my opening balances. So then I will get 501,470 minus 200,588, which will be 300,882. I will go to the next 1,373,700 minus 412,100, which will give me 961,600. Next is 1,523,480 minus 304,696, which will give me 1,218,784. But for me, my major focus is measured on this figure plus this and this, because this is what will give me my wear and tear that I am looking out for. Meaning that my wear and tear allowance will be 200,588 for class 1 plus 412,100 for class 2 plus 304,696 for class 3, which will give me what? It will be 200,588 plus 412,100 plus 304,696, which will give me 917,384. So this will be my figure that I will carry to the allowed deductions as a figure called wear and tear allowance. And I am recording it from working 1, which is 917,384. 917,384. So that I am recording it there. Okay. Seems these ones we are good. Then we go to note 9, which says that the qualifying amount for each factor. When they examine this question, they include information to compute the wear and tear. Most times, information to compute the wear and tear and information to compute the what we call industrial building deduction, IBD. So let's look at working 2, which is called IBD, and we're calling it industrial building deduction. Industrial building deduction. In class, I gave you the definition of what is an industrial building deduction. It defines an approved hotel, an approved building, and it gives conditions when which qualifies for what. When which qualifies for what. So then we use a customer table which will have details, then computation, then we shall have IBD. So then the first one, they are telling us that they were first put to use on February. Factory was in PG, so we have a factory in PG. Factory in PG, which has the qualifying amount of 416. So it is 416,000. We can have shillings in thousands. So it is 416. It was first put to use on July 2018, meaning that during the year of income ended December 2025, we have used it for all the 365 days times 365 over 365, which will give us how much is IBD. So let's compute and see. So we have 416,000 times 5% times 365 over 365 should give me 2,800. Then we have another factory building in Emetoma. The factory building in Emetoma was first put to use on 1st July 2025. So they had a qualifying amount of 368,000 times 5% times the period. Now, given that this was first put to use on 1st July 2025, we needed to compute how many days did we use it during the year of income, because we are looking at the year ended December 2025. So the year ended December 2025 starts from 1st January 2025 to 31st December 2025. So if the asset was introduced and was first put to use on 1st July 2025, it means that we have used this asset for a period of July, 1st July to 31st December. We did not have this asset from January to 30th June 2025. Meaning that the number of days, because the formula for IBD considers the number of days used during the year of income. Meaning that we need to see how many days are in July, how many days are in August, September, October, November, and December. So you will know that July has 31 days. Even August has 31 days. September has 30 days. 31. So when I total all these days, how many days do I have? It will give me 31 plus 31 plus 30 plus 31 plus 30 plus 31. This will give me 184 days. This is what the question wanted you to do. Now, some students, they use, when they are told that it is July, they say this is half a year. So they multiply by a half. Others get 365 divided by 2. When divided by 2, you get 182.5. Now, this one is wrong. It is wrong. You have to get specific days, which is 184 days over 365 days in a year of income. Because the year of income has 365 days. So when I put this into a computation, I will get 184 days divided by 365. I multiply by 5% times 368,000. And I will have 9,276 as my IBD. So I will get my total IBD. Total IBD will be 2,800 plus 9,276, which will give me 30,076. So this will be the figure I am taking in my computation. I'll go to my computation and I will have IBD as in working 2, which is 30,076. As simple as that. After having IBD, we're almost done. So then you add up. So we're gonna add up here. We're going to get the total here, total non-allowable. So let me add. So you get your calculator and press these figures there. So there is no magic. You have to get your calculator and press the figures. 82,7,202 plus 182,000 plus 246,000 plus 97,000 plus 207,000 plus 102,000 plus 98,000 plus 504,000 plus 163,449. So then this will give you a total of 2,426,651. So after that, then you move down and also add these ones. So when you add them, so basically you can add them total allowable deductions. So then you will have 72,000 plus 90,000 plus 52,000 plus 22,750 plus 55,428 plus 18,400 plus 917,384 plus 30,076. When you add, you get 1,258,038 as your total allowable deduction. So when you get total non-allowable deductions and you less total allowable deductions, you get what we call chargeable income. So the chargeable income will be, if I call this one B and I call this A, it will be A minus B. Will be A minus B. So when I do that, I will get A, which is 2,426,651. The way it is there, minus this figure of B, which is 1,258,038, which will give me 1,168,613. That will be my chargeable income. Now, after getting chargeable income, I'm going to lift it here. After getting your chargeable income as 1,681,168,613, then you make adjustments to chargeable income. So one of the adjustments, you less if there is any carried forward loss. Carried forward loss, these are losses that you incurred in the previous years and have been carried to this financial year. So the financial year had a carried forward loss on Note 10 of 36,700. So you less that. When you less that, you get what we call adjusted chargeable income. So get adjusted chargeable income minus 236. So you have gotten 1168,613 minus 236,700. Once you erase that, you get 931,913. 931,913. That will be your chargeable, adjusted chargeable income. Now, on the adjusted chargeable income, you tax that. That is the amount of money that is taxable. That is taxable income. So you provide for tax. So you can say tax and business income taxation is at 30%. So get tax at 30%. So multiply by 30% to get a tax. So the tax will be 279,574. That is the tax to pay. Meaning that this person or this company, Madueke Botoras Limited, would be paying this amount of money. But now the tax laws provide for what you call the tax credits. In the event that you have a tax credit, it will reduce on the tax that you are required to pay. So then you less tax credits. I normally tell my students that these are always free marks for tax credits because there is no computation you're going to put there. So just bring them, just copy them and bring them here. And now the tax credits are provided for in a sequence. So the first one is foreign tax credit. Foreign tax credit. So you have a foreign tax credit, and then 2, you have a provision withholding tax. Withholding tax. Then after withholding tax, we have provisional tax. We have provisional tax. So foreign tax credit is given as certain. Is given the question 500 or not 10. So to reduce the tax to pay. Withholding tax is given as 16,800. Then we have provisional tax given as 110 million. It means that our final tax payable will be the tax less the tax credits. Will be the tax less the tax credits. So then you would have 279,574 minus 30. You get 279,574 minus 3,500 minus 16,800 minus 110,000. When you do this, what remains is 122,274. It means that the person is required to pay 122,274,000 to the Uganda Revenue Authority at the end of that period. So that's what you compute, and that's how you do that number. And that's what I expected in the mock that the students sat. And the question wanted you to determine the chargeable income, which we have determined is here. Chargeable income, you can see chargeable income is here. And it also required you to determine the tax payable, which is here. But to do that, you needed to have the workings. The question was taking a whole 30 marks. Now, Students normally find challenges with theoretical areas. Like you can see, the examiner also expected you to have the theory. So the examiner is asking in question 1, part B, is asking the circumstances under which the commissioner may reject application for a private ruling. Now, first of all, you need to understand what is private ruling. What is what we call private ruling. So private ruling is a situation where the taxpayer, we have two parties involved now here. We have a taxpayer and the Commissioner General of the Uganda Revenue Authority. The taxpayer has a concept or the section in the tax law that is not clear to him or her, and then asks the Commissioner General, will ask the Commissioner General to provide an understanding of that section, and the taxpayer does this formally. So tax ruling is where the taxpayer requests the Commissioner General to provide his understanding of the application of the section of the tax laws. He asks the Commissioner General to provide that. And once the Commissioner General has provided that guidance to a specific taxpayer, then we say that the Commissioner General has provided a private ruling. And the private ruling is binding to the Commissioner General, meaning that once the client or the taxpayer has followed the ruling of the Commissioner General, it binds him, and it is not binding on the taxpayer. So now, the question was asking, under what circumstances may the Commissioner General reject the private ruling? Under what circumstances may the Commissioner General, in this case, reject the private ruling? Because now, not every other time, you are going to go to the Commissioner General to explain for you a certain concept. So there are times when the Commissioner General may reject that request. So let's look at the circumstances. Majorly, we have like 6 circumstances under which when the Commissioner General rejects the private ruling. 1, when the matter is already decided, when the matter is already decided in a tax assessment. In a tax assessment. When the Commissioner General has issued a tax assessment to you, then that is his communication, that is his decision. He cannot again give a private ruling on the same matter. 2, when it is covered, when the matter is covered by an existing, when the matter is covered by an existing practice note. So a practice note is where the Commissioner General provides understanding of he provides his understanding of a certain section, and it is gazetted in the tax law. It's gazetted in the tax law, and it gives a general view, a general understanding of that section to all taxpayers. So once he has already provided that in a practice note, then the Commissioner General may reject an application of the matter that has already been covered in the practice note. Then 3, when the matter is subject to an audit. When the matter is subject to an audit or objection. So here, when the matter that is being consulted on is under audit of URA, or the URA has objected a certain assessment, then the Commissioner General may reject application for private ruling for that particular matter. Then 4, when the matter is frivolous, when the matter is frivolous, or it is vexatious, or it is vexatious, or it is a vexatious application. A frivolous or vexatious application, it is that application that is not serious. Is not serious, and it lacks merit. It lacks merit, and it is intended to waste time of the Commissioner General. It is intended to waste time of the Commissioner General. So the system, it may reject it. Then 5 is the transaction. If the transaction is not carried out, the transaction is not carried out or unlikely to occur. If the transaction is not carried out or it is unlikely to occur. So the Commissioner General does not respond to hypothetical scenarios. He wants you to provide information why the transaction is likely to occur. And that's when he can give you a response. Then 6, if there is insufficient information provided. Insufficient information provided. So if your request or your application for a private ruling that lacks sufficient information to guide his decision making, or lacks facts and other documentation, then it may be rejected by the Commissioner General. Part B, B Roman 2 was asking about a tax agent. A tax agent, and so it was saying, explain the meaning of a tax agent and the circumstances under which the committee may cancel the registration of a tax agent. Now, what you need to understand by who is an agent, there are 2 types. So an agent is this person. So we have again, like 3 parties. We have a taxpayer. So we have a taxpayer, and then we have the URA, and then we have the agent here. So a tax agent is a person who links these people. These people, they deal with each other. URA wants tax from the taxpayer. The taxpayer has an obligation to pay the taxes to URA, but the taxpayer may not have enough knowledge on the taxes to pay, how to file, and may be busy. He may want to concentrate on core areas, and then URA expects you to pay the tax. So this tax agent, who is always a professional and has technical competence, has the knowledge and understands the tax laws, understands the administrative ways of paying taxes, comes to represent the taxpayer on behalf. He represents the taxpayer to URA on matters concerning tax filing, on matters concerning assessments, on matters concerning representation, and any other matters that the URA and the taxpayer may have to share or engage. So this tax agent comes in to do that. Now, we brought in a concept, and we are saying committee. Now, the committee, URA has a committee that is responsible for scrutinizing these tax agents and ensuring that any person who is registered as a tax agent on the URA register meets the criteria and is a fit and proper person to act as a tax agent. So they are the ones who are responsible. Every year, tax agents are appointed or are pre-qualified. So it's a pool of many people. Now, this committee of URA is the one that is responsible for scrutinizing the tax agents. Now, the question is asking, circumstances under which the committee may cancel the registration. Because I've told you that the committee is responsible for registration, it is also responsible for deregistration of the tax agents. So there are circumstances where a committee of URA may deregister this tax agent. And once the tax agent has been deregistered, means that he ceases to act as so and cannot represent anyone to URA on official matters. So there are specifically like 5 circumstances. One is if someone is an individual. If this tax agent is an individual, under what circumstance may he be deregistered? Now, here is where the tax person, where the individual is no longer a fit and proper person. Is when the individual is no longer fit and proper person to act as a tax agent. Take an example, someone has run mad, he is insane, and is not able to conduct business on behalf of the taxpayer. Or is insolvent, is declared bankrupt, is not a fit and proper person. 2, in case it is a partnership, in case it is a partnership, it is where the partner who has been nominated to act as a tax agent ceases to be a partner. When a partner ceases to be a partner in a partnership, or the partnership has selected another person to act as a tax agent, then it means that this other partner will be cancelled to be a tax agent. 3, in case of a company, if this is a company where the person who is nominated to act as a tax agent is no longer an employee of the company. When the person is no longer an employee of the company and the company has to appoint another person to act as a tax agent. Because like I was explaining, the taxpayer may select an individual to be their tax agent, may select a partnership, or may even select a company to act on their behalf. So here is when a person who is selected, an individual is selected in a company to act on behalf of the agent, ceases to be an employee. If he ceases to be an employee of the company, it means that their registration will be cancelled. 4, where the tax returns prepared by this individual, the partner, by the tax agent, where the returns prepared by the tax agent contain material misstatements, which are false. In short, when this tax agent prepares tax returns that are fraudulent, he prepares the information knowing that the information is wrong, but he goes ahead to prepare it on behalf of the taxpayer. It means that the tax agent has not fulfilled his obligations. Then the year registration can be cancelled. 5. Where the tax agent no longer meets the requirements of registration. No longer meets the requirements for registration. No longer meets the requirements for registration. So then there also your registration would be cancelled. So majorly, those are the areas. Then the last one, 6, is where the tax agent ceases to operate as a tax agent. Where the tax agent ceases to operate as a tax agent. So a tax agent may also cease to operate. Let's say has closed the business, and therefore it could be enough ground for the committee of URA to cancel the registration of this tax agent. So you can see the question was taking 30 marks on computation, and the 10 marks were purely theoretical. They were purely theoretical, and so it means that you would get 30 plus 10, so you get your 40%. So this 40% would add onto what you would get in section B in a bid for you to score the minimum marks to make you pass this paper, which is 50%. Now that is number 1. Basically that. So we're going to look at number 2 briefly, and then we see. So number 2 is about employment income. Question 2, which is about employment income. Employment income. And it says that Lukwanzi Grace is a qualified professional accountant employed by Electricity Transmitters Limited, a government agency in Uganda responsible for the transmission of electricity within the country, across the East African region and beyond. She joined ETL on 1st January 2014 after leaving her position in the private sector. During the year ended 31st December 2025, she received the following benefits: a monthly gross salary of 10.4 million, lunch provided by the company to all staff valued at 600,000 per month, airtime allowance of shillings 120,000 per month. Grace was provided with a company vehicle acquired on 1st January 2022 at shillings 120 million. She was offered a house for her residence, and a market value of a similar house in the same locality goes for 1.5 million per month. So what you need to note here is that they give you benefits, and among the benefits they normally examine is motor vehicle benefit, which is there, and then housing benefit, and then loan. These are the ones where they require computations. Others are just straightforward. So when they give you a house, they may give you a house, and then they also give you what the employee contributes. Grace acquired shillings 4 million free interest loan from ETL on 1st January 2025 for a period of 2 years, where the salary rate is 10% per annum. on 1st November 2025, Grace informed her employer that she would be resigning and her last day of work is 31st December 2025. Given her tenure since 2014, she qualifies for terminal benefits of shillings 200 million as a lump sum payment at the end of her contract. Life insurance cover of 3.2 million per annum. She also received medical insurance cover and a group personal accident cover valued at 2.6 and 750,000 respectively. Required. Determine Grace's chargeable income and tax liability for the year ended 31st December 2025. Now, what you need to note when they examine this question, they are testing you or they're asking a practical question. You are employed with a company. They have given you a contract. They pay you salary, but then you also have benefits that you get as an employee. So the question is, how do you tax them? What are the tax implications of the benefits that are provided to employees? That's majorly that. That's what the examiner is testing you and wants you to provide appropriate advice to an employee who does not know how to compute such benefits, or to an employer who wants to declare this tax to URA. Now, so this thing is, you first have the heading, which is Grace is chargeable income and tax liability for the year ended 31st December 2025. So that is your heading. We have amounts in shillings over thousands. So we shall have details here. You can have a column for computations in case they are there. Then you have amount and then comment. And then comment. Then comment. Okay. Comment. Now, the amounts that are given here, the examiner is testing whether the amount is either taxable or not taxable. Is that taxable or not taxable? So let's look at it. Saying a monthly gross salary of 10.4 million. So salary is taxable. Now what you also need to note is that employment income is guided by Section 19 of the Income Tax Act. So it looks at Section 19 provides for taxable benefits and non-taxable benefits. Now, we shall have a monthly salary. Since it is for the year, we don't have to say monthly. We're just going to say salary. Gross salary of is 10,400. Since it is for the month, we multiply by 12 to get how much is annually. To get how much is annually. So it means we will get 10,400 times 12, which would be 124,800. And this we will have a comment and say it is taxable. 2, we shall have lunch. Allowance is actually lunch. Lunch is provided to all staff. It's provided to all staff and it's divided at 600. So it is 600 times, this is actually 12,800. 124,800. It is 12 times It is 600 times 12. So you get 600 times 12, which will give you 7.2. So it is 7.2. Now, lunch, even though it was provided to all staff, it means that this one is, you not have, it will be not taxable here. Because lunch is provided to all staff. Lunch provided to all staff is not taxable. Then we have airtime allowance. Any allowances are taxable. It's 120,000 per month times, it is 120,000 by keeping 3 zeros times 12. So we shall have 120 times 12, which is 1440. So this will be taxable, 1440, and we say taxable. Next, Grace was provided with a company vehicle, so we shall say vehicle. And we say working one. So we shall have this one as working one. So when you are in an exam, you put that and you first skip so that you first do other areas which do not require computation. And once you finish, then you can always come back to it. She was provided with a company house, the same with this housing benefit. So this one will be working two. She was provided with a house in the city, goes for 1.5 million per month. Grace contributes 600 for the benefit. The company provides a security guard. Security guard is separate, so we shall have security guard. Security guard, which is how much? 250 per month. So it is 250 times 12. So now I get 250 times 12 to get the benefit. It will be 3,000. This one is not taxable according to practice note of 2001 as was provided by the Commissioner General. Grace acquired a loan, so we should also have a loan benefit. So loan benefit also requires the working, so we shall say working 3, and we first skip it so that we first pick the low-hanging fruits. On 1st November 2025, Grace informed her employer that she would be resigning on her last day of work, is 31st December. So terminal benefits. So how terminal benefits are handled? You handle 25% of the terminal benefits, and then terminal benefits 75%. So in accordance with section 19, subsection 4 of the Income Tax Act, it says that 35% of the terminal benefits, if an employee has worked for a period of more than 10 years for one employer, the terminal benefits are not taxable at 100%. We don't tax all of it. We tax only 75%, meaning that the 25% will not be taxed. So given that this joined in 2014 and is getting terminated in 2025, this person has worked for more than 10 years. And therefore, we shall tax only 75%. So we shall get 25% times 200 million. And this will not be taxed, which will be how much? It will be 25% times 200 million, which will be 50 million. So this one will not be taxable. So we shall say not taxable. Meanwhile, these ones are taxable. Where we left a space, these ones are taxable. This one is taxable. The motor vehicle benefit and the housing benefit is also taxable. So we multiply by 200 million for the terminal benefits that are taxable. So we shall get 75% times 200,000. When you multiply that, you get 150,000. So the 150,000 will be taxable. Will be taxable. Okay. So after that, we'll go to the next. The next is life insurance. Life insurance is not taxable. It is only taxable if the employer is a tax-exempt organization. But since this one is not a tax-exempt organization, we will not tax it. It is 3.2 per annum. So this one is not taxable. Then she also received medical insurance. Medical insurance cover is not taxable. Medical insurance cover valued at 2.6 is not taxable. Not taxable. Then there is group personal accident, GPA, valued at 750,000. This one is also not taxable. 750 is also not taxable in accordance with Section 19 of the Income Tax Act. So those are the benefits. Then you have your total chargeable income. Total chargeable income. So total chargeable income will be the total of the taxable benefits. But remember, we have what we have not yet worked on. So we need to have a working. Need to have workings here. So under workings, working 1, we had said it is motor vehicle benefit. So look here, this is motor vehicle benefit. So the motor vehicle benefit, to get the motor vehicle benefit, we determine the value of the vehicle. Well, they are telling us that they was acquired on 1st January 2022. So determine it will be 20% times A times B over C minus D. So to determine the value of A, we shall get the cost on 1st January 2022, which was 120 million shillings over 1,000. But remember, we're getting the motor vehicle benefit for the period ended 31st December 2025, meaning that we need to get the value of A, which is the carrying value of the vehicle, on the date it was first provided to the employee, which will be 1st January 2025. It means that we shall get the depreciation. Of course, the depreciation is provided with a notional depreciation of 35% times the value of the vehicle, 120 million. So that will be for that first year. It will be 120,000 times 0.35, which will be 42,000. So you get 120,000 minus 42K, which will give you 78,000. Now this 78,000 is the carrying value of the vehicle on 1st January 2023. Then we shall get the depreciation at 35% because we are using reducing balance times 78,000 times 0.35, which will be 27,300. We shall get 78,000 minus 27 27,300, which will be 50,700. This will be the carrying value of the vehicle on 1st January 2024. Remember, my interest 2024. My interest is to get the value of the vehicle on 1st January 2025. So depreciation at 35% times 50,700. So I get this times 0.35, which will be 17745 as the depreciation. So that I get the carrying value on 1st January 2025, which is my interest, which will be minus 50,700, which will be 32,955. This is the value of A on 1st day of the year of income. Now, the mistake students normally make, they will get the value of A as of 31st December 2025. So they would depreciate it more for another 1 year, which is totally wrong. You need to get the value of the vehicle when it is provided to him, like on the 1st day of the year of income, which will now bring up here in our formula, meaning that our motor vehicle benefit will be 20% times A, which is 32,955, times the number of days used in a year. Now he has used it for all the days in a year, minus D, which is the employee contribution. He is contributing 0. So then it will be what? It will be this times 20%, which will be 6,591. Should be the motor vehicle benefit. So the motor vehicle benefit, we bring it up here in our computation. And we have said it is reference to working one, which is 6,591. Now, what you need to note is that housing benefit is computed last. This is computed last. So you need to remember that. Then you go to housing loan benefit, which we call working 3. Loan benefit. The loan benefit, so the loan benefit is equal to the statutory rate. So you get the loan times statutory rate minus the company rate minus the company rate. That would be the loan benefit. So the loan that was provided to him is on note 6. He acquired 4 millions. So we multiply by statutory rate. They have told that the statutory rate is 10%. But the company gave him a loan only at 0%, because they gave him a free interest loan, which is 0%. And then even this one, you less the employee's contribution. So with idea, the mint is 4,000 times 10%, which is 400,000 on an annual basis. Even if it's given for 2 years, we're only looking at the benefit for only 1 year. So come up here, we put 400,000 as loan benefit referencing note 3. So after we do this, then we need to do housing benefit. That's why I told you that housing benefit is done last. This is the reason this is working to housing benefit. So housing benefit, we first get the chargeable income. So we first add the chargeable income. What is the chargeable income? Before considering the housing benefit. So we first add the ones we have without considering the housing benefit. So we add them. So we have 124,800 plus 1,440 plus 6,591 plus 400 plus 150,000. So this one will give me a total of 283,231. I bring it down here. 283,231. So when I get this, then I will add the market rent. What is the market rent? So the examiner has told you that she was offered a house for her resident, and the market value of the house is 1.5 per month, and Grace contributes 300 for the benefit. So to get the market rent, we'll get 1.5. We get 1.5 times 12 months to get how much is for the month, minus what they contribute, which is 300 times 12. So this one would give us how much? 1,500 times 12 will be 18,000 minus 300 times 12. 300 times 12 times 12, which will give you 3.6. So what would it have? 18,000 minus 3.6. So to mean that this one would be 1,400. So you add it here, and then you get what you call adjusted chargeable income. Chargeable income. So you'll get that 14 plus 231, which would have 297,631. So you get this. Now the formula is saying, after you get this, you get 15% of adjusted chargeable income. Adjusted chargeable income. So we shall get times 15%, which will give me 4,4,644. So 645. Now, housing benefit. It says take the lesser of A, the market rent, which is in this case 14,400, or B, 15% of chargeable income, of adjusted chargeable income, adjusted chargeable income, which would then now be 15% of the adjusted chargeable income is 4,4,645. So it means that of these, choose the lesser of. Actually, this is and, not of. It is and. So of this, you take the lesser. Now the lesser has now turned out to be that. So this is the one. So it means that we consider we consider market rent of shillings 14,400 being the lesser of market rent and 15% of the chargeable income. So it means that we want to consider this as our benefit, 14,400. So move up and we put our 14,400. Our 14,400. So when you add 14,400, actually the answer is already given here, because you have this plus this, which is now this one, which is 297. When you add them, you get 297,631 as our total chargeable income, which is 297,631. So this becomes our chargeable income. Now the examiner is asking us to tax it, wants us to tax it. So to provide for tax, we use the tax bands. So we use the tax bands, and that will be under working for tax payable. The tax payable, we shall have the bands and then the amounts and then the tax payable. So the first band, the second band, the third band, the fourth and the fifth. So there are 5 bands. So the first band is from 0 to 820. Get this, you get the answer there. Then this is from 820 minus 4020. Shall I get the answer there? Then 4020 minus 4920. Get the answer there. Then we get 4920 minus 120 million. You get the answer there. Now, it means that then the remainder is taxed in the first band, which is now 120 million minus 297,631. So then we have that, and we provide the tax. So get the difference. So this one will be, this one is taxed at 0%. We shall have 0% times 2,820,000. The tax will be 0. At the end of the day, we need to determine the total tax liability. Total tax liability. Then the next one will be 2,820,000 minus 4020,000, which is 1.2. Which is 1.2 times 10%. Then 4020,000 4,020,000 minus 4,920,000. You'll get 900,000 times 20%. Shall get the tax there. Times 0.2. This will give you 180,000 tax. And this one will give you 120,000 tax. Then you get 4,920,000 minus 120 million, which would be 115,080 times 30%, times 30%, which will give you 34,524,000. Then we shall get 120 million minus 297,631,000. Which will give you 177,631 times 40% times 0.4%, which will give you 71,052,400. Then you add the taxes. Get that plus 34,524,000 plus 180,000 plus 120,000, which will have the tax of 105,876,400. That would be the tax payable for this person. Earning 297 million would pay 105,876,400. And that would be the tax payable for the year ended 31st December 2025. Now, part B of the question is asking, in accordance, this is to be, in accordance with the Income Tax Act, Cap 338, explain the different benefits received by employees that are not included in the dimension of chargeable income. So these benefits that are not included is what we have actually not been including up. One, we have pension. Pension is tax exempt. Two, we have medical expenses, what we call reimbursements. Then three, we have what we call life insurance. Life insurance, so long as for taxable employers. For taxable employers. Then four, we have NSSF contribution by the employer. The 10% NSF contribution. Local service tax. Then five, the obvious one, the threshold. The threshold of 235,000 is not taxable. Then six, we have 25% terminal benefits. Terminal benefits for employees who have worked for more than 10 years for one employer, and many others as specified in section 19 of the Income Tax Act. as specified in Section 19 of the Income Tax Act. So this is what the examiner expected you to answer for this question. What you also need to note is that in the new amendments, the Parliament of Uganda is in the process of approving the new changes for different taxes. And among them is tax bands. They will be changing them. And once approved by the president, they will be effective 1st July 2026. But for this examination date, such taxes will not affect this examination because they are not yet approved. You're going to do the exam before they are approved. They are just proposals. So there is no need to worry for you to go out and worry about the new taxes. So what you need to follow and apply are the taxes that we were applying in the past. These are the two areas that we have looked at today: business income and employment income. These are areas that are very common both in the exam and in the field of taxation that you need to master as a candidate or as someone who has actually studied tax. So in the next episode, we are going to look at other areas. We're going to look at question 3, question 4, and question 5 before we finish. So we're going to have this mock debrief in 2 sessions, session 1 and session 2. Thank you so much. I appreciate for listening to me, and I encourage you to come to MAT Abacus for the next sitting of December 2026. Thank you. Have a blessed evening.